Look, we've been doing private credit investing for almost 3 decades now, and I would say we try to really focus on those defensive sectors, stable sectors, the ones that we think are not cyclical, preferably larger companies, market leaders with pricing power, and we're very focused on cash flow generative businesses. And so to some extent, the volatility that we see in the market, we try to not be too exposed to that volatility through our asset selection and very cautious underwriting.
Which sectors are best positioned if we are heading toward a more defensive overall market environment?
The way that we've assembled these portfolios and where we are spending our time, I would say probably on business services, mission-critical business services. We're exposed to software services, healthcare. We're spending a lot of time on healthcare around the world. Obviously, there are areas where we're probably more cautious than others in healthcare. But, we have teams dedicated to healthcare investing or software investing. The other thing which is key in private credit is diversification, right? We're not really indexed to any particular region. We're global in nature, investing pretty much where we find good opportunities, backing these companies that have the features that I mentioned.
James, I want to pick up on the comments around software, because the reality is when we see public markets rally around some of the AI hopes, some of that froth, enthusiasm, excitement spills across to private markets as well. What are you seeing on the private side around some of the AI developments and how that's really put some sort of pushback into private markets around software?
I would say the type of software businesses that we like to land, they're probably on the more mature end of the spectrum. Their average EBITDA margin would be around 35%. They tend to have low churn. They're really infrastructure businesses to some extent. And interestingly, by the way, a lot of the owners of these businesses tend to be these long-term core investing investors or infrastructure even funds would have bought into those software assets given their stability. But the question you're asking is the right question. In particular, every time we diligence an asset, we want to know what can disrupt this asset. And so when it comes to software, beyond obviously the competitive environment, we always ask the question around technology. How good is that technology stack in particular? But also the question around AI. And can AI do anything, disrupt this particular kind of software business? And that's why we tend to focus on those larger companies. We're not really lending to early stage software or technology businesses.
James, I was looking at some comments you're making around tariffs, and the reality is this morning, as the market looks at whether the economy is going to head towards a recession because of the market businesses holding off on investment, capex, some of the uncertainty that continues to linger around the tariffs. I saw another comment suggesting, look, this could dent the M&A environment if it goes on for much longer. What are you hearing on that front? Because this is meant to be a grand year on M&A. M&A is meant to be back in a big way, but banks on Wall Street this week have been hit too around the uncertainties. So is there a potential now, as we talk about the tariffs, that M&A is going to be sidelined in 2025?
Look, I think it may be a bit early to figure out what M&A is going to look like in 2025. Just to give you a sense of activity, in 2024, on our global private credit platform at Goldman, we invested about 2.5 times more than we had previously in 2023. So we had seen a pickup in M&A throughout last year. Now, you should know that in private credit, M&A is only one of the engines of growth and activity of what we do. We have a global portfolio of about 600 positions around the world. These companies tend to be a little bit on the larger end of the spectrum. They're acquisitive. They tend to be on the hunt for smaller assets. And so we continue to lend to these businesses. We do refinancing in our portfolio. And so to some extent, even when M&A slows down, or even in 2022 almost came to a halt, then we find ways to continue to invest in our portfolio. That's really important. I would say when I look at certainly the first quarter of 2025, we're very active. In the US, in Western Europe, even in Asia, we're very active. But you're right, with the recent volatility, things could also change very quickly.